Imagine holding a machine that literally just legally prints over $650 million in pure cash every single year.
Right.
Like a machine that costs almost nothing to maintain. It operates with staggering efficiency, and it just completely dominates its market.
The dream business, essentially.
Exactly. But now imagine taking half of that cash, like driving down to the bank, withdrawing it in tightly packed $100 bills, and then using it to buy gasoline just to pour it on a raging fire in your own backyard.
Yeah, that sounds like an act of sheer financial sabotage.
It does, right. But today on the deep dive, we are going to look at a universally recognized company that might be doing exactly that.
Well, this is going to be good.
And if you are listening to this, you definitely know the brand. I mean, you have seen their products on the street, in hospitals, on fashion runways, and probably sitting in your own closet right now.
We were talking about Crocs, Inc., aren't we?
Yes, we are. Ticker symbol CROX.
The global leader in casual molded footwear. A completely fascinating subject for a forensic analysis, honestly.
They absolutely dominate the molded clog space, you know, the sandals and those incredibly lucrative gibbets charms.
Right, the little plastic add-on.
Yeah, exactly. But they also own another brand, a privately owned casual footwear business they acquired back in 2022 called HeyWDUDE, which makes lightweight slip-on loafers.
Which is where the fire comes in.
Exactly. So we are going to unpack their absolute latest Q4 2025 earnings report, which just published on February 12, 2026.
Okay, let's get into it.
And looking at the baseline data we have in front of us, there is a lot to dissect here.
Oh, absolutely.
Like, as of Q3 2025, our internal tracker showed their market capitalization sitting at $4,285.12 million. So over $4 billion.
Right.
But curiously, by this Q4 2025 report, our tracker literally just shows an NA error for the market cap. Like, it's just broken.
Well, we will definitely solve that pricing error later on.
Right.
It is tied directly to the share count. I can guarantee you that.
Right, because the tracker does confirm their outstanding shares have dropped down to exactly 50.23 million.
Which is a significant drop.
Yeah, it really is. But before we get to the stock price and all that, I want you to listen to the narrative. Listen to what the CEO told Wall Street on the Q4 earnings call just weeks ago.
I am bracing myself.
He stated, and I quote, "We reported a better-than-expected holiday season. Our powerful value creation model drove strong free cash flow."
Oh, of course he did.
And wait, when I ran the initial numbers, the cash generation actually is massive. So if you're a retail investor reading that quote, you're thinking, you know, this is a company firing on all cylinders.
I am going to stop you right there.
Okay.
Because this is exactly how the trap is set for the retail investor. You know, corporate cheerleading is a highly refined art form.
Yeah, but they did have strong cash flow.
A powerful value creation model is just a wonderful phrase, carefully crafted by a public relations team. I mean, it sounds incredibly impressive on a conference call.
It does sound good.
But let me tell you what does not usually result from a powerful value creation model. A consolidated net loss of $81.2 million for the year.
Wait, but if they had a better-than-expected holiday season, right, and they generated strong free cash flow, how on earth did they post an $81.2 million net loss?
Well, you don't reconcile it by just accepting the press release at face value.
Right.
You reconcile it by tearing the financial statements apart, literally line by line. We are not here to read the marketing brochure to you.
No, we definitely aren't.
Today, we are putting Crocs through a strict, uncompromising 9-point forensic audit. We're going to strip away all the corporate spin, isolate the core operations, and find out what is actually happening beneath the surface of this entire footwear empire.
Man, I am ready for it. If the CEO's narrative doesn't match the audited GAAP reality, we really need to find the leak. So where does the audit begin?
Moving to point 1, the numbers drill down in profit margins.
Okay, let's pull up the consolidated statement of operations here.
Let's look at the top line first.
Right, so total 2025 revenue was $4.04 billion. It is down slightly, like exactly 1.5% from 2024. But if you dissect that consolidated number, you honestly have two entirely different stories going on.
Which is typical in M&A situations.
Yeah. The Crocs brand itself grew 1.5% to $3.32 billion. That is a massive revenue base that is just continuing to grow.
Sure.
And their operating income on that specific segment is phenomenal, like $1.11 billion from the Crocs brand alone.
Yes, but let us examine the gross margins on that specific segment. What does it actually cost them to produce those revenues?
Well, the gross margin for the Crocs brand is holding incredibly steady around 61.3% for the year.
Which is wild.
Right. That is just a 30 basis point decrease from the prior year. Now,
Yeah.
just to clarify for you listening, a basis point is just 1/100%.
Exactly.
So a 30 basis point drop is just 0.3%. It's basically a rounding error. To maintain a 61.3% gross margin on a physical manufactured product is astounding.
It is the operational equivalent of gravity-defying economics, frankly.
Yeah, how do they even do that?
Well, think of the core Crocs brand not as a traditional apparel company, but more like a pure software company.
Software.
Really?
Yes, because they aren't dealing with complex stitching, multi-layered textiles, or intricate leatherwork like Nike or Timberland.
Oh, right, it's just foam.
Exactly. They are taking proprietary cross-light foam, heating it up, and injecting it into a mold. Once that initial mold is paid for, the marginal cost to produce the next shoe is practically pennies.
Wow. Right.
So a 61% margin means for every $100 of clogs they sell, they get to keep $61 just to pay for marketing, overhead, and straight profit.
That's incredible.
The front-of-house operations are brilliant, but you are ignoring the swinging door to the back. Look at HeyWhyDUE.
Right. Let's look at the HeyWhyDD side. HeyWhyD revenues for 2025 were $714.8 million.
And the trend.
Which represents a plummet of 13.3% compared to 2024.
And look at the operating income for that specific segment. This is where it gets dark.
Oh, wow. Yeah. In 2024, the HeyWhyDD segment generated an operating profit of $137.4 million.
Decent. But in 2025...
In 2025, they posted a loss of $668.8 million. Let me put that operational reality into perspective for you.
Please do, because that's a huge swing.
Think of the core Crocs brand as a pristine, highly optimized server farm. It is humming along, generating immense profit with almost zero friction.
Okay, I like that visual.
HeyWhyDUE right now is acting like a rotting produce stand out back.
A rotting produce stand. Ouch.
Yes, because the longer that inventory sits out, the more value it loses and the more it actually costs to maintain it. In 12 months, that brand swung from making a respectable $137 million profit to incinerating almost $700 million.
Wait, hold on. But wait, I need to push back on the math here.
Go ahead.
Because you cannot mathematically generate a $668 million operating loss simply from a 13.3% drop in revenue.
You're starting to see it.
Right. If they sold $714 million worth of shoes this year, the raw materials to make those shoes didn't suddenly cost them $1.4 billion out of nowhere.
No, they did not.
Operationally, a 13% revenue dip should squeeze your margins, right? Maybe tip you slightly into the red if overhead is too high. But it doesn't create a $700 million crater literally overnight. There has to be a ghost in the machine here.
You are asking the exact mechanical question that bridges the gap between operational reality and accounting manipulation.
Okay, so where is the ghost?
To find that ghost, we have to look past the cash register and open up the accounting footnotes. Moving to point 2, one-off effects versus operational development.
Okay, let me look at the income statement here. Oh, there it is. A line item for asset impairments.
There is the ghost.
Wow. In 2025, Crocs recorded a staggering $738.1 million in asset impairments.
Read the footnotes on that number. Break it down.
Okay, the footnotes break this down as $307 million of that was a goodwill impairment recognized specifically in Q3 of 2025.
Right.
And then another $431.1 million were other asset impairments recorded across the year.
Which totals the $738 million.
But hold on, as a retail investor, I read analyst reports all the time that tell me to just ignore these charges.
Oh, I know you do.
Right. They say, adjust these numbers out. It's just a non-cash charge. It's a one-off. It's just management cleaning up the balance sheet, right?
I am going to ruthlessly interrupt you right now because that is the exact toxic narrative that destroys retail portfolios every single day.
Really? But it's non-crash.
It is just a paper loss. Ignore it. No. As an auditor with 20 years of experience, let me define exactly what a goodwill impairment is.
Okay, give it to me straight.
It is not an accounting technicality. It's the financial equivalent of a management team standing up in a crowded room, turning on a microphone and admitting, we drastically, embarrassingly overpaid for an acquisition and we set shareholder value on fire.
Wow. Okay, but Wall Street prices cash flows, right? Not paper losses.
They do, but...
So explain the mechanism to me. Why is goodwill impairment so critical if no physical cash actually left the building this year?
because the cash already left the building.
Oh.
Let's walk through the timeline. Back in 2022, Crocs acquired HeyWyDDE for $2.04 billion.
Right, I remember that.
When you acquire a company, you buy their tangible assets.
Mm.
The physical shoes in the warehouse, the sewing machines, the cash in their register.
Sure, the hard assets.
Let's assume the physical tangible assets of HeyWyDDE were worth roughly $500 million at the time.
Okay, so what happens to the remaining $1.5 billion that Crocs paid above that physical value? Where does that go?
The accounting rules dictate that the premium, the $1.5 billion overpayment, goes onto the balance sheet as an intangible asset called goodwill.
Okay.
Management basically tells the auditors, we paid this massive premium because this brand has incredible future cash flow potential. We built a discounted cash flow model projecting 10 years of massive growth, and that justifies the premium.
Right. They're paying for the future.
Exactly. Goodwill is literally the quantified premium of hope.
The quantified premium of hope. I like that. So it just sits on the balance sheet as an asset, inflating the total value of the company.
Yes. But the SEC and the accounting boards do not let you keep that hope on the balance sheet unchecked forever.
Right. You have to prove it.
Every single year, management is forced to run an impairment test. They have to rebuild that exact discounted cash flow model using today's reality.
Oh, I see where this is going.
They have to look at the 13.3% drop in revenue and project that forward. And when they ran that model in 2025, the math completely broke down.
Because the future cash flows of a brand dropping 13% cannot possibly justify a $2 billion valuation.
Precisely. The auditors forced management to write down the value. So when Crocs takes a $738.1 million impairment charge across 2025, they are admitting that the hope they paid for in 2022 is dead.
Wow, that is brutal.
In just 3 years, management managed to destroy over a third of the acquisition's total value. That is not a balance sheet cleanup. Wow. That is a massive multi-$100 million strategic failure, cutting directly on the income statement.
That drastically changes the context of the CEO's earnings call then.
Doesn't it?
Because he was on the Q4 call talking about, quote, investing thoughtfully and strategically behind our brands.
It is the absolute pinnacle of cognitive dissonance.
Yeah, it really is.
You cannot boast about thoughtful, strategic investment while your accounting department is simultaneously writing off $750 million because your most strategic investment of the decade is collapsing in on itself.
It's like two different realities.
If we strip away the one-off cover-ups and calculate the true operational reality, the HeyWyDDE segment is a catastrophic drag. It essentially wiped out the vast majority of the operating profit generated by the mighty Crocs brand.
It really is two completely different companies forced into a single financial statement.
Exactly.
But, if the income statement is heavily distorted by this $738 million paper anvil, we need to look at the structural health. Is the disease spreading to the actual operations?
That is the right question. To determine that, we leave the income statement and look at where the liquidity is trapped. Moving to point 3, the balance sheet quality and debt check.
Okay, let's check their leverage first. In the cash flows from financing activities for 2025, I see they generated $819 million in proceeds from bank borrowings. But they also repaid $947 million in bank borrowings. So effectively, they paid down $128 million in debt over the course of the year.
That is correct.
I have to say, in an environment where interest rates are punishing, deploying capital to pay down debt is highly responsible management.
I will concede that a net debt reduction of $128 million is a positive sign.
Okay, good.
It indicates the core enterprise still has liquidity and access to credit markets. But long-term debt is only one side of the balance sheet equation.
What's the other side?
An auditor looks for the hidden leverage, the leverage of unsold goods. I want you to look at their working capital. Specifically, investigate the cash flow statement regarding inventory and accounts receivable.
Okay, let me pull up the changes in operating assets and liabilities section here.
Take your time, look closely.
All right, for inventories, it shows a negative $13.8 million, which means inventory consumed $13.8 million in cash. So they actually built up their inventory levels this year. For context, in 2024, inventory provided $22 million in cash, meaning they were efficiently selling through their backstock then.
And what else? Look at AR.
Furthermore, accounts receivable consumed $6.1 million in 2025.
I want you to synthesize those exact numbers against what we already know. HeyWyDDE revenues plummeted 13.3%. Sales are dropping rapidly.
Yeah.
Yet the consolidated company is consuming cash to build up inventory.
Yeah.
They have more shoes sitting in warehouses at the end of 2025 than they did at the beginning. Why is that an incredibly dangerous dynamic?
Because fashion inventory is a depreciating asset.
Yes.
If your sales are dropping off a cliff, but your warehouses are literally filling up with product, you are building a dam that is eventually going to break.
It has to break.
I mean, HYDE makes canvas loafers. If they can't sell those loafers to consumers at full price, what do they do with them? They are going to be forced to liquidate.
Exactly. Creeping inventory in a declining sales environment is a ticking time bomb.
Right.
The longer a shoe sits in a distribution center somewhere, the more it costs in storage fees, and the less relevant it becomes to the consumer.
Fashion moves fast.
It leads to one inevitable outcome. Aggressive, desperate discounting. They will have to slash prices just to get the product out of the warehouse to free up the trapped cash.
Yeah.
And what happens when a premium brand begins slashing prices?
Well, your gross margins get absolutely crushed. And honestly, worse, you train the consumer never to pay full price again.
Exactly. You destroy brand equity.
But what about the accounts receivable bloat? You mentioned that as a hidden leverage, too.
Accounts receivable consuming cash means they are booking revenue from wholesale partners, department stores, shoe retailers.
Okay.
But those partners have not actually paid Crocs the cash yet. When sales are declining but receivables are growing, it raises the specter of channel stuffing.
Wait, explain channel stuffing for the listener. How does that artificially inflate the current numbers?
Imagine it's the end of December. The VP of Sales for HYDE realizes they are going to severely miss their quarterly targets.
A panic situation.
So they call a major retailer and say, look, take 50,000 pairs of shoes right now. We will give you an extended 90-day payment term, and we guarantee your margins if you have to mark them down.
Oh, wow.
The retailer obviously agrees. It's risk-free for them. Crocs ships the shoes and legally books the revenue on December 28th.
So the income statement looks better.
Exactly. But they haven't collected a single dime.
So they essentially pull future demand into the current quarter just to make the numbers look acceptable, which creates this massive accounts receivable balance.
Yes.
And when Q1 rolls around, that retailer isn't going to buy any more shoes because their backroom is already completely stuffed with the December order.
Precisely. It steals from tomorrow to pay for today. A bloating accounts receivable balance paired with building inventory while revenues fall is a classic textbook warning sign of earnings quality deterioration. The balance sheet is flashing bright yellow right now.
This is exactly why a surface-level read is so dangerous.
It will kill your portfolio.
Like a quick glance just says, hey, they paid down $128 million in debt, balance sheet is strong. But the forensic read says, wait, they are trapping cash in unsold inventory and unpaid wholesale invoices while their secondary brand is in free fall.
Yes.
So if the income statement is a mess of impairments and the balance sheet shows this operational fiction, how do we know if this company is actually viable at all?
We strip away the accounting estimates. We ignore the depreciation schedules, the impairments, the accruals, and we look at the raw, unadulterated lifeblood of any enterprise. Moving to point 4, the cash flow analysis.
This is the absolute truth serum. Cash doesn't lie.
Cash is clinical. It is entirely immune to public relations. Let us calculate the exact metrics here. We need to determine their free cash flow yield.
Okay, let's do it.
To do that, we take operating cash flow and subtract capital expenditures. Run the exact numbers from the 2025 consolidated statements of cash flows.
Okay, I have it right here. Net cash provided by operating activities is $710.43 million.
Think about that number.
Yeah, that's over $700 million in actual tangible cash generated from operations.
Now let's find capital expenditures.
Okay. Purchases of property, equipment, and software? Wow, that is remarkably low.
Read it out.
It is only $51.23 million for the entire year.
Stop right there. A company generating over $4 billion in revenue only required $51.23 million in capital expenditures to maintain its operations.
That is barely over 1% of revenue.
Exactly.
If you look at like a car manufacturer, an airline, or even a semiconductor company, they have to spend billions every year just upgrading factories and equipment just to stay alive.
Right.
They are on this perpetual treadmill of capital reinvestment.
But Crocs, they're essentially pouring hot foam into established molds.
Right.
The capital expenditure required to maintain the core Crocs business is incredibly tiny. It is the ultimate asset-like cash machine. Now run the calculation. Operating cash of $710.43 million minus CapEx of $51.23 million gives us a free cash flow of what?
That gives us a massive free cash flow of $659.20 million. Pure, unencumbered cash generated in a single year.
Now, we must calculate the yield. We divide that free cash flow by the market value of the enterprise.
Okay, using the tracker.
According to our internal tracker, the last known valid market capitalization from Q3 2025 was $4,285.12 million. Divide $659.20 million by $4,285.12 million.
Okay, let me do the math here on my end. 659.20 divided by 285.12. Wow. That is an astonishingly high free cash flow yield of 15.38%.
15.38%. If you are listening to this, just pause and let that number sink in for a second.
It's huge.
In the world of institutional finance, if you find a stable company with a 6% to 8% free cash flow yield, you consider it a highly attractive value investment. 15.38% is almost unheard of for an enterprise of this global scale.
Yeah, you don't see that every day.
I mean, for every $100 of company value you purchase in the stock market, the underlying business is generating over $15 in pure free cash every 12 months.
Wait, I have to square the circle here. If I pull up the very first number we discussed today, the consolidated net income, it was a loss of $81.198 million.
Right.
So if you are generating $659 million in free cash, how can you look the IRS and the SEC in the eye and tell them that you lost $81 million?
That brings us to the accruals ratio. We must calculate the exact gap between the paper reality and the cash reality.
Okay, how do we do that?
We take the net income, which is negative $81.198 million. We subtract the operating cash flow, which is positive $710.43 million. What is the mathematical gap?
Okay, so negative 81.198 minus 710.43. The difference creates a massive accruals gap of negative $791.63 million.
Yes.
A nearly $800 million delta between paper profit and real cash.
This is highly, highly unusual. Usually when a forensic accountant uncovers a massive accruals gap, it is a catastrophic red flag because the inverse is happening.
Oh, like they have paper profits but no cash.
It's exactly. Usually, a fraudulent or failing company is reporting huge paper profits to appease Wall Street, but generating zero actual cash, which implies they are faking the profits with aggressive accounting tricks. Think Enron.
Wow, okay. But here, the polarity is completely reversed.
Precisely.
They are generating an avalanche of actual cash, but reporting a paper loss. And the reason for that paper loss
is the $738.1 million HAYDUDE asset impairment we discussed in point 2.
Oh, right. The ghost.
It is a massive non-cash charge. It completely crushes the net income on the income statement, making the headline numbers look like an absolute disaster. But because it's a non-cash accounting adjustment, it does not stop the actual physical cash from flowing in every time a teenager buys a pair of Crocs.
So if you are a retail investor who only read the headline, Crocs posts $81 million loss, and you panicked and sold your stock, you got completely faked out by the accounting rules.
You lost your shares to an institution who read the cash flow statement.
The underlying core business is a cash-printing juggernaut. And notice, they pay absolutely no dividends, none.
Which is a choice.
So management has over $650 million in free cash flow just piling up on their desk this year. What on earth are they doing with it?
Which leads us directly to the next phase of the audit. How does management actually deploy that mountain of capital? Moving to point 5, share count and market capitalization.
Let's trace the data. And this actually explains the error on our tracker we talked about earlier.
Let's hear it.
The market cap fell from $6.16 billion in Q4 of 2024 to $4,285.12 million by Q3 of 2025.
A steep drop.
That is nearly a $2 billion evaporation in the total market value of the company in less than 12 months. Wall Street was clearly punishing them for the HAYDUD deterioration.
Absolutely.
But meanwhile, the outstanding shares dropped from 61.3 million in 2023 to 59.3 million in 2024, down to exactly 50.23 million by the end of 2025.
And how precisely did management achieve that drastic reduction in the share count?
Well, according to the Q4 earnings report, they executed massive stock buybacks. They repurchased approximately 6.5 million shares for $577 million.
A huge sum.
That is almost 10% of the entire company's outstanding shares retired in a single year. From a pure mathematical standpoint, this is highly accretive.
If you just look at the math, yes.
Right. If you have fewer shares outstanding, each remaining share owns a larger percentage of that massive 659 million people free cash flow. If I'm a shareholder, I'm thrilled. They are returning that cash pile directly to me by increasing my ownership stake.
Hold your enthusiasm. Do not accept corporate buybacks as an automatic virtue. I want you to look at this critically. Think like a forensic auditor here.
Okay.
Look at the timing, the macro environment, and the context of the operational failure.
Okay, I'll bite. What is the alternative narrative then?
They took $577 million of hard-earned cash from the core Crocs business and spent it buying their own stock. During that exact same 12-month window, the market capitalization, the total aggregate value the market assigns to the enterprise, evaporated by nearly $2 billion.
Right. The stock price was falling dramatically.
So I pose this fundamental question to you and to the listener. Was this a brilliant Warren Buffett-esque capital allocation move?
Maybe.
Was management aggressively buying drastically undervalued shares, ruthlessly capitalizing on their massive 15.38% free cash flow yield? Or were they acting as the buyer of last resort?
Oh.
Were they throwing over $500 million of cash into a furnace to artificially prop up a stock price that was collapsing under the massive weight of the haywire DDE disaster?
Oh, wow. When you frame the mechanics like that, it changes the entire picture.
It changes everything.
If you spend $577 million to buy your own stock, absorbing 10% of the entire supply, and the total value of your company still drops by $2 billion, that means the institutional market was dumping your stock aggressively.
Oh, we're fleeing.
Wall Street saw the HYYDDE impairment coming. They saw the 13% revenue drop. If Crocs management had not been in the open market blindly buying 6.5 million shares, how far would the stock have actually crashed?
Exactly. It raises severe questions about the psychology of management's capital allocation.
It really does.
When a company's core secondary asset, HYDDE, is failing spectacularly, using your precious cash reserves to buy back stock instead of fixing the operational rot, upgrading supply chains, or preserving liquidity is a highly defensive maneuver.
Right. It's a shield.
It masks the decline in earnings per share because you are artificially lowering the denominator. It is financial engineering attempting to outrun an operational reality.
So the $577 million buyback isn't necessarily a sign of supreme confidence. It is highly likely a symptom of desperation.
I would argue it is pure desperation.
They are using the cash generated by the Crocs brand to create a smokescreen. Don't look at the $738 million impairment failure over here. Look at the shiny share buybacks over there.
It is the oldest sleight of hand trick in the corporate playbook, and it is our job to see through it. If management is distracted by financial engineering, what operational threats are they completely ignoring? Moving to point 6, risk assessment.
Let's dig into the fine print of the Q4 call. Analysts are always trying to model the next 12 months, right? The CEO gives future guidance, and he explicitly mentions a normalized run rate, but he adds a very specific, heavily caveated sentence.
Read it verbatim.
He says, quote, "As long as there's no changes from a tariff policy standpoint, everything is in the base, and then we get to a much more normalized run rate."
Tariffs. The ultimate geopolitical wildcard.
And this isn't just some theoretical anxiety either. If you look at the 2025 10K, they explicitly explain why the Crocs brand gross margin dropped by 30 basis points.
The fine print always tells the truth.
The SEC filing states it was, quote, primarily due to unfavorable duties and higher freight and fulfillment costs. Unfavorable duties.
Let us expand on this supply chain vulnerability because it is the actual Achilles heel of their beautiful 61% margin. Where are the physical Crocs manufactured?
Well, the 10K notes, they rely heavily on third-party manufacturers, overwhelmingly located outside the United States. We are talking about factories in Asia, primarily Vietnam and China.
Let us break down the mechanics of that risk. You have a product that costs mere pennies on the dollar to manufacture overseas. Right. That labor arbitrage in material cost is the sole reason they maintain that astronomical 61% gross margin. But that entire margin structure is highly dependent on a frictionless global trade environment. What happens if the geopolitical winds shift?
Well, if a new administration imposes heavy import taxes, say a 20% or 30% tariff on footwear manufactured in Asia, that 61% margin gets squeezed instantly.
Precisely. Crocs does not own the factories, but they own 100% of the geopolitical risk of the supply chain.
That's terrifying.
If an import tax is slapped on those clogs at the port of entry, management is faced with an impossible choice. They either eat the cost, which instantly destroys their gross margin and evaporates their free cash flow, or they pass the cost on to the consumer.
And you can't just keep raising prices.
No. If you raise the price of a basic foam clog to $70 or $80, you risk hitting a hard price ceiling and destroying consumer demand completely.
That is a massive vulnerability, and it dovetails perfectly into another existential risk: consumer trends and brand fatigue.
Oh, fashion is ruthless.
Let's be brutally honest. Crocs have had an incredible resurgence over the last 5 years. They went from being the punchline of a joke something chefs and gardeners wore, to literally high fashion streetwear. But fashion is inherently fickle. What happens if the clog trend fades even slightly?
That is the perpetual risk of any apparel brand. But why is that specific risk so much more acute for Crocs today than it was 3 years ago?
Because they have absolutely no safety net.
Exactly.
If the core Crocs brand falters even a little bit, there's nothing to catch them. The HeyWDDD brand, which they bought for $2 billion specifically to be their diversification play, their second pillar of growth, is currently in absolute free fall, dropping 13% in revenue and losing hundreds of millions.
They've got the farm on it.
They spent $2 billion to buy a parachute, and the parachute is full of holes. If the main engine sputters, the whole plane just goes down.
A very apt analogy. The concentration risk is severe. The entire enterprise is entirely reliant on the continued, uninterrupted global dominance of a single style of molded clog. But to be entirely objective in our forensic audit, we must acknowledge the current reality of that dominance. Moving to point 7, opportunities and strengths.
And we really have to give credit where credit is due. There are massive strengths here.
Oh, undeniably.
You cannot generate a 15.38% free cash flow yield by accident. The core Crocs brand possesses an incredibly deep economic moat. Let's look at the geographic breakdown. They are not just a U.S. phenomenon anymore.
No, they are truly global.
International revenues make up almost half of the Crocs brand sales, and they grew double digits in 2025. They are expanding aggressively in China, India, Japan, South Korea, and Western Europe.
I will admit, with clinical respect, that the underlying business model of the molded clog is incredibly resilient. We discussed the practically non-existent capital expenditure required.
Right, the $51 million.
The gross margins are fantastic, but beyond the spreadsheet, there is an intangible strength in how they execute their go-to-market strategy.
Oh, their marketing and distribution strategy is genius. Let's talk about direct-to-consumer, or DTC. The 10K notes that DTC makes up over half of their enterprise revenue now, and it is growing significantly faster than their wholesale business.
Explain the margin mechanics of DTC versus wholesale for the listener. Why is that transition so powerful?
Okay, so when Crocs sells a shoe to a department store wholesale, they have to sell it at a discount so the store can make a profit, right?
Right, they share the margin.
But when Crocs sells that exact same shoe directly to you on Crocs.com or in their own retail store, they capture the entire retail price. They keep the full margin.
Yes, and what else?
Even more importantly, they capture your data. They know your email, your size, your location, and exactly how often you buy. They own the customer relationship, which makes future marketing vastly cheaper.
And how are they driving that consumer engagement at the top of the funnel?
Through collaborations and hyper-personalization. This is where the Crocs brand truly separates itself from everyone else. They treat a basic foam clog as a literal blank canvas for pop culture.
It is brilliant marketing.
They partner with everyone. McDonald's, Toy Story, high-fashion designers like Simone Rocha, celebrities like Sydney Sweeney and Jelly Roll. They drop limited edition collaborations that literally sell out in minutes.
Creating the hype cycle.
It creates artificial scarcity, massive hype, and continuous free organic marketing on social media. But you know what the real secret weapon is? The financial masterstroke. Gibbets.
Ah, the plastic charms.
Yes, the gibbets, those little plastic charms you plug into the holes of the shoe. Think about the margins on those from a manufacturing standpoint.
Basically 100%.
They are tiny pieces of injected plastic. They cost pennies to make, yet they sell them for $5 or $6 each. A consumer buys a $50 pair of Crocs and then spends $30 personalizing them with 5 or 6 gibbets.
It is an ecosystem.
Exactly. It turns a static shoe into a dynamic platform. It drives recurring revenue because kids want to trade them and update their shoes for different seasons. It creates a deep emotional attachment to the product. It's brilliant.
From an operational standpoint, it is an exceptionally strong model. They have essentially created an open-source footwear platform with SaaS-like recurring microtransactions attached to it.
That's a great way to put it.
The product itself is cheap to produce, highly customizable, and globally recognized. When evaluating the core Crocs brand in isolation, the management team is executing flawlessly.
I feel the forensic hammer about to drop.
Running a great consumer brand and running a great publicly traded enterprise are two vastly different skill sets.
Right.
A great brand requires marketing and supply chain logistics. A great enterprise requires masterful capital allocation. Which brings us to the most critical evaluation of this audit. Moving to point 8, management credibility and capital allocation.
Okay, it is time to hold management's feet to the fire. Let's cross-check their historical actions with their current reality.
Let's do it.
We keep coming back to the original sin of 2022. Management spent over $2 billion in cash and stock to acquire AYDDE. I actually went back and read the transcripts and press releases from that time.
And what did they promise?
They pitched it to Wall Street as a massive transformational growth driver, a brand with incredible momentum that would diversify their portfolio and double their revenue footprint in a matter of years.
Let us ruthlessly unpack this management team's capital allocation track record. It has been 3 years since that acquisition closed. We do not need to rely on their projections anymore. We have the empirical data. What is the reality today?
The reality is that AYDDE revenues are down 13.3% year over year. Operating income went from a $137 million profit to a devastating $668 million loss.
And how did management communicate this colossal failure in 2025?
They hit it.
They quietly recorded $738 million in asset impairments, mathematically admitting to the SEC that they destroyed over a third of the acquisition's value in just 36 months. Yet while quietly burying that failure in the footnotes, what was the actual tone of their Q4 2025 press release?
The exact quote we started the deep dive with. We reported a better-than-expected holiday season. Our powerful value creation model drove strong free cash flow.
It is the cognitive dissonance that is so profoundly alarming from an auditor's perspective.
It really is.
Management is loudly broadcasting the success of the core brand, utilizing corporate speak to create a halo effect of competence, while quietly attempting to bury a $750 million strategic failure.
Look at the Crocs. Ignore the AYDDEs.
They are using the massive cash flow of the Crocs brand to hide the sins of the AYDDE acquisition, burning $577 million on stock buybacks to distract investors from the reality that they torched shareholder value on disastrous mergers and acquisitions.
Look, I have to play devil's advocate here to try and defend them for just a second.
Go ahead.
This is the exact same management team that successfully orchestrated the turnaround of the Crocs brand itself a decade ago. They took a brand that the market considered a dead fad and turned it into a multi-billion-dollar, high-margin juggernaut. They clearly know how to operate a footwear brand.
I am forcing you to look at the numbers, not the legacy. I agree. They are brilliant at running the day-to-day operations of Crocs. Their credibility on core operations is an A-plus feat. The 61% margins and the 15% free cash flow yield prove that unequivocally.
Right.
But their capital allocation on M&A has been a severe, unmitigated detriment to shareholder value. Their credibility on acquisitions is an S.
Wow.
When the CEO states they are investing thoughtfully, the empirical evidence of a $738 million impairment proves the exact opposite. If a CEO is an A-plus operator but an F capital allocator, the enterprise is constantly at risk.
Because they'll just waste the money they make.
Exactly. Because the better the operator runs the core business, the more cash they generate. And the more cash they generate, the more money the poor capital allocator has to set on fire on the next hubristic acquisition.
Wow. A great business trapped inside a deeply flawed corporate strategy. That is an incredibly tough spot for an investor to navigate. I mean, the machine works perfectly, but the person driving it keeps steering into a ditch.
That is the perfect summary.
Which leads us to the final conclusion of our analysis.
We have analyzed the margins, the accruals, the balance sheet, and the management. Moving to our final point, point 9, the forensic verdict. It is time to synthesize the true financial health of the enterprise.
So how do you sum up a company that is simultaneously printing gold and setting it on fire?
We deliver the final judgment by strictly separating the operational reality from the consolidated distortion.
Okay.
The earnings quality of the core Crocs brand is spectacular. This is not an accounting illusion. The 15.38% free cash flow yield proves that Crocs is a genuine hard cash generating powerhouse.
That part is real.
Yes. The economic moat is deep, the margins are remarkably resilient against inflation, and the operational execution on DTC and international expansion is elite.
But what about the consolidated financials as a whole, the big picture?
The consolidated financials are deeply, perhaps permanently, scarred by the AYDDE acquisition. Management's attempt to distract from the $738 million write-down with heavy stock buybacks and upbeat corporate speak shows a dangerous reluctance to admit a strategic failure.
They're avoiding the issue.
They are using financial engineering to mask the bleeding rather than applying a tourniquet. The fundamental financial health of the underlying asset is incredibly strong, but capital allocation remains a critical existential threat to shareholder value.
What an absolute wild ride of a balance sheet. We started this deep dive with a glowing press release about a better-than-expected holiday and a powerful value creation model.
And we ended in a very different place.
Right. But by looking past the PR spin, understanding the actual mechanics of goodwill impairments, and tracing the actual cash, we found a Jekyll and Hyde scenario.
Exactly.
Massive, almost unprecedented cash flows fighting desperately against the anchor of a failing secondary brand and questionable management decisions.
It fundamentally proves why you must always read the footnotes, run the cash flow yield yourself, and never, ever rely on the headlines.
I couldn't agree more. And that brings us to the end of our forensic audit. But as always, we want to bring you, the listener, right into the room for a final thought. If you are holding this stock or thinking about buying it, here is something to mull over as you digest everything we've uncovered today.
Given that the core Crocs business requires an astonishingly low $51 million in capital to run and prints over $650 million in free cash flow every single year, ask yourself this. What would this company be worth today if management simply swallowed their pride, admitted defeat, spun off or shut down the HeyYDDD brand entirely, and returned 100% of that massive cash flow directly to you?
Now that is a multi-billion-dollar question. Thanks for joining us on this deep dive. Keep questioning the numbers, read the footnotes, and we'll see you on the next one.